Well, hi. It's Module 2 of Legal Aspects of a Small Business. This is BA 121B with Sarah Holtzclaw. Let's look at the disclaimer. You'll see this a lot. You've seen it before, and you'll see it every time. I am by no means an expert in the field of legal advice. There are experts. We're talking about different kinds of entities of business. There's lots of um, links on the module at the underneath the lecture. And there are people who can advise you in this. Even some small business administration, the small business development offices in Alameda County, even the state people in Sacramento can help you deciding what you need to do. But we're going to go through some of the larger kinds of business. They're called, what kinds of legal entities that you can form your business, and it all kind of depends on, there's a lot that depends on that form of business that you've decided to take on. These are the kinds of businesses that we're going to go through. We're going to go through sole proprietorships, partnerships, corporations, limited liability corporations, because there is a difference, and then we'll touch on nonprofits because there are some people who are interested in starting nonprofits. So the question that comes up on a lot is, why at all does it matter how you start it? Well, there is four main reasons that you need to care about what kinds of business you start. There is the liability that you have when you start your business, and whether or not you are personally liable for what's happening in your business. There are tax implications. Some of the ways corporations, partnerships, those entities, it's easier to find money if you are one form or another. And then it is more cost efficient to start as sole proprietor than it is as a corporation and a nonprofit. So you'll want to look into each of these. So the three big ones are sole proprietors, partnerships, and corporations. So you'll see from this these graphs, these pie charts, that the vast majority of businesses in the United States are sole proprietors in that number in business. So there's it's somewhere shy of 75% of businesses in the United States are sole proprietors, but they are not um, dominant in their fields, right? So the vast majority of sales and of profits are through corporations. So the larger the business, the higher the sales. That just kind of makes sense, right? And the higher the sales, most likely the higher the profits. So sales and profits, the vast majority are by corporations, but the largest number are of small business, of businesses in the United States, are sole proprietorships. So we're going to go through each of these. What is a sole, and then we're going to talk about, in each one, we're going to talk about the pros and cons of each one. So a sole proprietorship is owned by a single person. So as soon as you put a second person in there, you no longer own a second owner. It is no longer a sole proprietorship. So it is owned by one person, and it is by far the most, as you saw in that pie chart, by far the most popular and most common type of business. The piece about a sole proprietorship is that the owner has unlimited liability. So it's not the company necessarily, it's the owner. You are tied together in your taxes. You'll see a couple bullet points down that business income is your personal tax income. You are taxed. It is tied to you. If something happens to you or to that business, it also happens to you. It's easy There are very few regulations required, very little paperwork required to start your own business. In some cases, all you really need to do is get a customer, and then you have a business. Um, and we're, like I said, we're going to go through some of those pros and cons, but one of them is that funding can be limited in a sole proprietorship. So, and you usually have to borrow from your own 401ks and retirements, your own savings, your brothers, your wife's, your father-in-law's, that sort of thing is where, or your credit cards. So it can be risky. Uh, so we've touched on a couple of these things. Sole proprietorships on your own, they're very easy to form. Sometimes, like you said, all you need is a customer, and all of a sudden you're in business. One transaction and you have a business. Now you do have some paperwork that you need to do in the county. You need to get a fictitious name, which is weird. So you can't have the business just, John Doe. It has to be John Doe in, Enterprises or John Doe's Food Truck or whatever. So you file that with Alameda County, if that's or Contra Costa County or Santa Clara County, wherever you're doing business. Um, so it's really easy to start and to form a sole proprietorship. You have much greater control and flexibility in this form of business entity, in this legal form. You have a whole lot more leeway as to what you get to do. There aren't really a lot of records that you have to keep. Of course, you got to keep your sales records and things for tax purposes, but you'll see in other forms like in corporations and in nonprofits, you got to have quarterly meetings and you have to keep all those records. You have to keep minutes. You have to have board of directors and all that kind of stuff. In a sole proprietorship, it's just you and the business. And one of the good things is that that business income becomes your income. So it's kind of just that is your income. Um, so there aren't any other tax forms that you have to fill out. You don't have to do a K-1 for the partnership or a whole tax return for the business. They are the same. It's just a different um, form, that Schedule C, that you do in addition to the rest of your taxes. And there's a lot of potential tax benefits that you can do. So let's just say you make $100,000 in profits and for your business and in income, then you can take off. So that's your income that you'd be putting onto your tax form, but then you would be able to deduct all of your expenses from that. So that your net income is a whole lot less than your gross income, because you could take out all the rent and you can take out advertising costs and you can take out all of your cost of goods and you can take out any of your office supplies and travel and all of that kind of stuff, then gets taken off the bottom line so that you're not taxed on that type of stuff. So there's some really good tax benefits to having a sole proprietorship. And one of the better things is that there's not very much intervention in sole proprietors. There's so many of them, and there's sometimes just you, and that's it. No employees, and that kind of stuff. So sometimes there's so many of them that the governments don't necessarily get involved unless there is some insurance issues or something's happened. So that liability that we talked about, that's kind of a con too. So if something happens to your business, somebody gets hurt, not only is your business, when you are tied to that business, not only is the business at fault, but you are at fault. So whatever happens to the business happens to you. Sole proprietors have a harder time getting money. They just, because they have a greater potential of failing, for some reason, they have a harder time borrowing money from banks, and if they do, it might be at a higher income or a higher interest rate. And like I said, as soon as you put in one extra person, it becomes a different type of business, legal entity. So it won't accommodate any more than one. It's sole means only. So it doesn't have any wiggle room when that comes to into play. And um, given there is the tax benefits that you can take all of that stuff off of your income, but there is not as many tax advantages as if you were a limited liability corporation. Um, as a For some reason when you say Inc. Incorporated at the it's the John Doe Incorporated, meaning that you have that you are a corporation for some reason, there is a credibility that goes along with that. It doesn't necessarily mean anything. It's just that feels to people as if you're serious about the business, and that you can be trusted a little bit more than just John Doe. Because of all of the tax advantages and taking things off of your personal taxes, if you add a Schedule C, which is that form on your taxes that you have to include if you own your own business as a sole proprietor, that Schedule C happens to be the most audited form by the IRS. So you need to make sure if you're adding that Schedule C into your taxes that you've done it right and that you have all of the backup documentation that can go with it. So if you're taking advertising off of your income, you better have some receipts that say that you actually spent that on advertising. If you claiming that you drove 10,000 miles for your business in your personal car, you better have a log in your car that you keep track of every mile that is done for business. So you need to make sure, because they are audited the most. Okay, the next form that we're going to talk about is partnerships. Multi-purpose ownership. You can have unlimited number of owners in a partnership, actually. So you can have law firms that have multiple offices in several different countries, and they're still a partnership. But they're managed by an agreement and partnership and percentage of ownerships. So the more partners you bring on, obviously, the less percentage per partner. So it all kind of depends as to how much both in liability that you want and in profit. So if you got two of them and it's 50-50 or 70-30 or 60-40, whatever it is, then that agreement needs to you need to say that, and you need to write it down. In a partnership, you also have unlimited liability. They are really easy to start as well. However, they also have that unlimited liability. So you are, whatever happens to the business, the partners are liable. They're taxed to the person, just like a sole proprietorship. They live and die with the owners. So if you have three people and one of the owners dies or moves away and that company, then you have a new partnership. It may do business under the same company or the same name and logo and all of that, but you are actually have a new partnership as they come and go. Partnerships have a little better opportunities for funding, but not like corporations still. Pros and cons of the partnership. More owners contribute more capital, right? So you get three people as partners. They bring their savings and their credit cards, or you get five people for and you get two more people's income and savings and credit cards and in-laws and that sort of thing. There's quite a few. There's very low startup costs, just like sole proprietorships. And because you're bringing more people in, you have shared that financial responsibility, but you also have the ability to increase your business more and generate more income because you've got double or triple the amount of people that are working towards that same goal. Um, you can split out the roles and responsibilities so that people are complementing each other. Somebody's really good at the finances, somebody else is really good at marketing, somebody else is really good at the operations. So you can utilize those skills and generate more income. The cons are that you need to make sure that just because he's your best friend, he doesn't necessarily make a good business partner. Just because he's your brother doesn't mean, or your dad doesn't mean that you can work with him. So you need to make sure before you go into business with a partner that it's the right partner. Um, and you need to make sure because that you can trust the person, that the person is, because if something goes wrong, um, joint authority, as it says, equals joint liability. So you both have the say of how the business is going to be run, but you're both liable as to how when something goes wrong. Um, Same thing, right partner means the difference of opinion. There's a lot of, you're not the only opinion, you're only decision maker anymore. You got to be able to share in those making and make sure that you have um, talked about the lines of authority and that sort of thing. I used to work with a partner in a partnership, and one was the CEO who did a lot of financial stuff, and one was the president, and he did more of the operational stuff. So they had a fairly clear line of their responsibilities. Um, Partnerships have a kind of more difficulty in borrowing money. And again, if a partner leaves or dies, that it generally dissolves and you create a new one. The third section, the third kind of business that we're going to talk about is a corporation. This is where the line draws, where the business is separate from the owners. So in this case, you now have a whole lot more paperwork that you need to file because now the corporation is liable and the owners are not. Um, and it can be, for example, that you are still the only owner, but as a corporation, you're just not there's a line of separation. When you decide to incorporate, however, you got to have a board of directors and you got to have meetings and you have to keep those, you have a whole lot more reporting responsibilities. Um, the good thing is that you're not liable because it's the corporation that's liable. They have now separated the income and profits and liabilities to that corporation, and it becomes its own entity. The paperwork is because it is has that independence from the owners. There is a whole lot more regulation and paperwork that goes with it, both from the state and from the federal government. There's a couple kinds of corporations, and we're not going to get into them. There is such a thing as called a C corp and an S corp. A C corp is just the general corporation, and when you say it's taxed twice, it means the corporation is taxed, but then you as an employee is also taxed. So that's what means by taxing twice. S corp is a form that has tried to um, mitigate that, but you need to look into it further to see if that's the type of corporation that you would like to um, form. The benefit of a corporation is that if one of the owners dies, that corporation still lives. So, for instance, if you wanted to pass the company on to your son or daughter, or your nephew, or to your best friend, that'd be okay. The corporation stays as it is, and then just that the founders are gone or the people that the owner's gone, but the corporation still lives on its own. As we said earlier, when the corporation, just the word Inc. or incorporated or uh, the word corp at the back of a company name can often allow you to raise additional capital. It's more permanent. It's on its own, and for some reason the banks like that better. So it's a little bit easier to raise money for corporations. This kind of just reiterates some of the same information. The shareholders have limited liability, and it's separate liability from the owners. That it goes on for itself. It's easier to raise capital. Um, as a corporation, you can actually sell stock in that corporation. So not only are you going to the banks to borrow money, but you can sell stock in it, which means you're getting more owners into the corporation. Of course, the downside of getting more owners means that you have less profits for yourself, but the benefits is that that the stock sale is not debt, right? It is a slice of the profit that you're owing them. It's not something you need to pay back. Um, there is tax benefits, corporation and corporate tax benefits to having it incorporated. Um, and then when owners come and go. So, for instance, if I purchased Coca-Cola stock, I could then sell it to somebody else, and then that new person is the owner of Coca-Cola. So those shareholders come and go. And the good thing is also as an employee, you become an employee of the corporation, and one of the if you're the only stockholder of that corporation, then it's easier to separate your income from the corporation's income. Some of the cons of corporations are that it's really regulated. It's there's the double taxation, but there's a lot more things you have to do. The paperwork is a lot more just to form it at the state level. Um, you have to follow a lot of bigger tax rules, so I would make sure that you get a really good tax accountant if you decide to go into and form as a corporation. It is the most expensive type of business entity to start. Okay, the next one is limited liability corporation. The federal government tried to do a little bit of a hybrid between partnerships and corporations so that they had more of the tax benefits of the corporation, of the partnerships, but a little bit more of the liability part. Benefits of a corporation. So, in a limited liability corporation, it says it right there. The members are um, they're liable, but they're not completely and totally liable. So there's kind of a happy medium between the partners and the corporation. It's taxed as a partnership. So a limited liability corporation has tax advantages that you are taxed. It's through your own personal taxes. So you get that benefit, but less of the liability. So it might be the way that you would like to form. Who knows? You have to create some management agreements. There isn't that double taxation issue. Um, and just like your partners, it lives and dies like a partnership or sole proprietor. It lives and dies if somebody comes and goes. So it's kind of a hybrid into. So you'll see it's an LLC, um, and there is a YouTube video underneath um, in the module that you can see on each of these types of corporation entities. So what of a limited liability corporation? Um, Shareholders limited liabilities, it doesn't matter how many, um, there's an unlimited number of members. Now in an LLC, you're actually members, you're not owners, which is where you're not stockholders. Um, you are members of the LLC, but you can have just an unlimited amount. Um, you can transfer your membership or your ownership pretty easily. Um, Income is not earned; it's self-employment. It's managed. So um, it's an interesting kind of, like you said, it's a hybrid. So um, you need to make sure that it's an interesting hybrid. So you need to make sure that of the tax that whether the tax benefits are there for you. I again am not um, an attorney when it comes to this, so I am not an expert in limited liability corporations. There is quite a few regulations that go along with it, so you'll want to make sure that you form your company in the right um, area, and we'll see a little bit later that you can actually, if you start out as a sole proprietor, you can morph into something else. It's hard to go back. So if you wanted to start out as an LLC, you want to make sure that that's the case, and that's the best way for you. The thing about LLCs is that the law is still evolving. There's not a lot of, they're still trying to figure it out. So make sure again that it's what that you have that flexibility. Okay, the last one we're going to talk about is a nonprofit. So a nonprofit is something that is some entity that is engaged in charitable, educational, religious, or artistic activity. You got to make sure that if you form as a nonprofit, that there is a public interest in your nonprofit. You can form, if you wanted to form a political, organization, that's a different tax code, 501c4s versus C3s and that sort of thing. So um, the thing about nonprofits is you can act like a business, you just can't make a profit, right? That's what they mean by nonprofit or not for profit. You can make money doing it. As a director, you would have a salary, but all the profit that is made goes back into the company. So there isn't shareholders, there isn't profits distributed to any of the members or the officers or the owners. You would take an income from it, but you would not take a profit. The profit has to be put back into it. Certainly nonprofits can have paid staff. They can have interns, they can have volunteers, they can have all those kinds of things. Um, some of the biggest companies in America, quote unquote companies in America, are actually nonprofits. So Boys and Girls Club of America, Red Cross, that kind of thing. Those are all nonprofits, and they have um, hundreds of thousands of employees. So the benefits, pros and cons of nonprofits. A nonprofit is tax exempt, so you're not taxed in any way. You might be you do have to do if you're selling something, you do have a sales tax and those types of things, but but the company and all your profits are not taxed. You can write grants. You can take donations, which is not something that corporations can do. And those donations are tax deductible to the people giving you that money to you. There's limited liability, and a lot of times there's discounts on services for nonprofits. There is a lot of scrutiny under nonprofits. Um, you have to have a board of directors. You have to keep the minutes. You have to keep the records of them. You have to keep a very good, not that you wouldn't in any other case, but you have to keep a really detailed bookkeeping and records. And you have to keep them for a long time in case they're audited. And in fact, every year, every 2 years, your financials need to be professionally audited by a tax accountant so that there is record that you are doing what you've said you're doing. So I touched a little bit on this. At the bottom is the sole proprietorships with the arrow that says you can climb your way up that ladder, but it's very difficult to climb your way back. So if you start out as a corporation, it's really difficult to go back down into partnerships. The paperwork, the whole registration is different, right? The bottom two you're registering at the county, the others you're registering with the state. So it's a lot harder to go down this ladder than it is to go up it. Arrows on the sides kind of show you who's the liability, and the cost and regulations go up as you are um, as you go up the ladder of the kind of entities. So nonprofits and corporations have the most regulations and they cost the most to form, but the partnerships and sole proprietorships have the most personal liability. Um, so why does it matter? Um, so it matters because of that legal liability. It matters because of those tax implications. It matters because of the way to raise money, and it matters because of what you need to do, the paperwork, the cost of the paperwork, um, and and the kinds of things that you need to do in your in your business life, depending on the kind of entity and legal entity that you are, whether you're a partnership, sole proprietorship, corporation. All of these four things are the one of the biggest, the four main reasons why it matters how you actually form your business. And this is from the very, very beginning. All right, so again, check the links out, do your research, understand the pros and cons, and try to, um, if you don't know, um, the best thing to do is always to start out in the sole proprietorship and move your way up that ladder versus starting out at the top of the ladder and not being able to go back down. But do your research, most definitely.